bank rate maintained at 0.1%. Okay, boring stuff. Let's just get the boring stuff out first, all right? Interest rate remains unchanged at 0.1%, okay? Total QE, okay? Total QE remains at 895 billion pounds, okay? Regarding the voting, okay, for the Bank of England, there's actually this vote whereby, they carry out to see if any members voted for an increase or a cut or a remain unchanged for interest rates, okay, as well as quantitative easing, okay. For interest rates, of course, at the moment, we pretty much expect there's going to be no change, right? There's going to be no change. Quantitative easing wise, all right. Back in August, I think there were 9 voting members, okay. One of them voted for a cut in quantitative easing, Michael Saunders, all right. This time around, there are 9. 1, 2, 3, 4, 6, yeah, there are, oh, sorry, last month, correct, there are 9. Right now, there are also 9 members, okay. And there are actually 2 members this time around that voted for a cut in quantitative easing, okay. So it's actually, I would say, the central bank is starting to lean towards QE unwinding, okay. Well, QE tapering first before unwinding, okay. So that's actually a good point, all right, a positive point coming out from the Bank of England, okay. Next, yeah, so back in August, there was this projection materials being released, okay. Quarterly GDP for the 3rd quarter of this year, I think it was, 2.9%, okay. However, yesterday, the Bank of England actually revised this 3rd quarter GDP downwards, okay, from 2.9 to 2.1%, okay, and they explained that this reflects the emergence of some supply constraints on output, okay. So yesterday, I think hours before the Bank of England meeting, all right, the UK PMI data, flash PMI data for the month of September was released, and yeah, if you guys were to look at the data, there's actually a considerable slowdown, okay, in the expansion of business activities in the UK, be it in the services sector or the manufacturing sector, okay. And of course, they highlighted that supply constraint is the main issue, okay, behind this whole slowdown in the expansion of business activities, okay. So it actually tallies with what the data actually tallies with what the central bank has just mentioned yesterday, all right. So that was the GDP, okay. Now moving on to inflation, the BOE, okay, actually expects inflation to rise slightly above 4% during Q4 of this year due to energy and goods prices, okay. So recently we have seen an increase in inflation in the UK, right? I think it was 3.2% on year-on-year, all right, year-on-year, which is definitely way higher than the central bank's 2% target. Now, if the central bank were to actually forecast, expect inflation to go above 4, then that's like easily more than 2 times, okay, it's slightly above 4%, right? So it's like more than 2 times of what the central bank will be targeting, right? Will be targeting, okay? Its goal in inflation goal, right? So the question now to ask is, will the central bank be doing anything, okay, with regards to that? I mean, across most of the central banks, okay, the central bankers, they actually mentioned that inflation is transitory due to temporary rise in oil prices, used vehicles, so on and so forth, blah blah blah. Okay, basically inflation is transitory, right? Not so much for the US, right? I would say, okay. Otherwise, we wouldn't be hearing Jerome Powell, getting more inclined towards a tapering, right? To actually sort of like provide this downward pressure on inflation, okay. So for the Bank of England, it's actually similar, right? Here comes the crescendo. Let me show you the minutes for the 0.65. Now, this is the fun part. All members in this group agreed that any future initial tightening of monetary policy should be implemented by an increase in bank rate, all right? Even if that tightening became appropriate before the end of the existing UK government bond assets purchase program. Look, normally I would tell you guys that, the central bank would actually want to, carry out some form of tapering, before actually considering hiking interest rates, right? That's I would say more like the norm, right? But not for the case, okay, for the Bank of England, okay, because well, probably because the QE structure for Bank of England is different from some of their central banks, right? So like for the Fed, for Bank of Canada, they have been purchasing at a rate. They give you a rate. Say, for example, Bank of Canada is currently purchasing 2 billion Canadian dollars worth of bonds on a weekly basis. Sorry, on a monthly basis. Okay. So, sorry, on a weekly basis. Okay, weekly basis for Canada. So, they provide this data in terms of a rate, a pace, okay, but not for the Bank of England, because the Bank of England, they give one lump sum, one big figure, right? 895 billion pounds of quantitative easing in total, okay? So they do not provide the rate because, the rate may change from month to month, depending on how the economy were to respond to the QE being injected into the economy, right? So in this case, we can actually be expecting a rise in interest, a hike in interest rate, okay, even before the QE program for the Bank of England ends, okay? So why is that the case, all right? Basically, the worry is inflation, all right? If the central bank is actually expecting inflation to rise slightly above 4%, it may actually get out of hand, okay? It may actually get out of hand, right? So let me show you another point. How do I know that, inflation is the main cause? At its previous meeting, the committee had judged that should the economy evolve broadly in line with the central projections in the August monetary policy report, some modest tightening of monetary policy over the forecast period was likely to be necessary to be consistent with meeting the inflation target sustainably in the medium term. Some developments during the intervening period appeared to have strengthened that case, okay? Some developments during the intervening period appeared to have strengthened that case, okay? Although considerable uncertainties remain, right, due to COVID. So we can see that, if let's say the current economic status, okay, the current status of the UK economy were to move in line with the central projection, okay, provided during the previous meeting in August, then some form of tightening, okay, maybe increase in interest rates or QE tapering may be necessary. But over here, the BOE actually acknowledged that the developments in the UK economy have strengthened that case. Okay, what this means simply is that we have to look at some form of tightening soon. Okay, otherwise nobody knows what's going to happen. Okay, things may turn bad and things like that, right? So with that, we can actually be expecting, okay, a hike in interest rates. Yes, a hike in interest rates this year, 2021, all right? Look, inflation, the central bank will not want to wait for inflation to hit 4% or slightly above 4%, okay, as projected, before carrying out an interest rate to, to ease prices, all right, to ease maybe mortgage loans and things like that, right? Oh, sorry, to actually increase the interest rates to actually to actually create some easing in prices. So to wait until the 4% inflation target projection, I would say, is hit, then to carry out this whole interest rate hike to ease off some of the pressures, okay, may be too late, all right, maybe too late. So yeah, the conclusion this time around is that we can actually be expecting an interest rate hike this year. It's very soon. I know it's like, I don't know, 3 months from now, okay? So
for that increase, for that increase, is that your view or is that a Bank of England statement?
Okay, that is not the Bank of England's view. Okay, so interpreting the statement, the contents that has been released in the monetary statement, that is how I see it. All right. And on top of that, okay, analysts on Wall Street, okay, they are actually expecting earlier, they have actually carried forward an earlier what do you call it, forecast, projection, expectation of a hike in interest rate, the first interest rate hike. Okay, so I think later on I'll be pasting some articles to to show you guys on the news. All right, but yeah, as of right now, personally, I would be expecting an interest rate hike as early as late this year or early next year. Okay, so
there's only another 3 more months to the end of the year, so you want to be a bit more specific on which month we're looking at?
I give you the month right now, December. All right, why is that the case? Because the next meeting will be in 4th of November. Personally, 4th of November, a hike in 4th of November is, it's not so, they are not as extreme as the RBNZ. Okay, they're not as extreme as the RBNZ, and progress in terms of COVID, progress in terms of economic recovery, it's not as resilient. The economy is not as resilient as the New Zealand economy, so they cannot expect, a hike as soon as November, because it's the next meeting, right? So December would be something that I am looking at, okay, or maybe the next meeting after the December's meeting, probably like January or Feb, okay? So yeah, like I mentioned, they will be meeting next in November 4th, okay? And I think Governor Bailey will be speaking, okay? Now, that's very important. He will be speaking next Tuesday at a dinner event at 0200 GMT plus 8, okay? I wonder what he's going to be having for dinner, okay? Given that the UK prices in UK has already risen so high, okay? And next Wednesday as well, he will be speaking at a ECB forum on central banking at 23:45 GMT plus 8. Now, I would want to pay attention to these two meetings, especially the second one on ECB forum on central banking, okay? Because, I mean, to be honest, during the last meeting, okay, when they actually discussed about how the individual committee members felt on, a consideration on interest rate hike, whether the conditions, the criteria has been met for a consideration of interest rate hike, okay? They did not say in the interest rate statement. They did not mention anything about it in the interest rate statement, okay? It was during the testimony, the BOE's testimony, that we actually learned that, oh, so there was actually a discussion on that, and half of the members, half of the committee members, 4 out of 8, all right, felt that it's time for us to consider, okay, an interest rate hike. So the next part would be what we have just seen, right? An interest rate hike can actually take place before the QE ends, okay? So at the moment, I'm actually very hawkish on the British pound, all right? So if you guys are trading, all right, my advice is this: if you want to trade the pound, okay, try to avoid the safe haven currencies, okay? Try to avoid pound yen, pound dollar, and pound francs, all right? I would go for these cross pairs like pound Aussie, pound Kiwi, and things like that, especially pound Aussie, okay? Why is that the case? Because as you guys already know, at the moment, the Evergrande saga is ongoing, and as of, I think, late yesterday or early on today, there was a news saying that they have yet paid the interest to debtors, okay, as of which were actually due yesterday. So it's a bit of a roller coaster ride in terms of the saga and things like that. So when we have like economic uncertainty, political uncertainty around the world, the safe haven currencies, okay, are likely going to move, okay, and we also know that pound is a high risk currency, right? Similar to like Canadian dollar and the other major currencies as well. Okay, so yeah, I'm still going to be looking at a bullish pound. Okay, but yeah, I'm going to pay more attention on the cross pairs, the minor pairs. Okay, not against the safe haven. All right. So with that, yeah, that's all I have to share for the Bank of England. Then with that, I'll hand it back to Scott.
All right, thanks for that, Kim Hong, as well. And also, that was essentially the conclusion as well. Someone did mention about the summary at the end there. So you got the conclusion here first in regards to interest rate rises. So definitely keep monitoring the LCMS Traders Club for updates on anything that we hear in regards to that as well first. So it is Friday, and just before we get into the CAD analysis, I'll just share my thoughts on the US dollar index now. I'll bring the charts up thanks to Sam Trade. So we've got the US dollar back down to the very low 93s or so. It did actually breach 93 briefly, 92, 94. And there's an interesting situation playing out. And what I want to share is, so we've got the context here of the US dollar. It has pulled back, even though we did have the FOMC come out and just mention, you know, when tapering was very likely to take place, although there's still a lot of stimulus around in regards to how much money they are actually putting into the economy. What I want to show now is the volatility index for the S&P 500. So there's almost what I would describe as a bit of a dislocation nearly. So we've got, when this is down, typically what we will see is equities will be moving higher or remaining stable. So we're not going to see a lot of selling in equity. So when the volatility index is elevated, such as in February, which we saw it got quite high to 37 or nearly 38, that's when there was a lot of selling, when there was a hint of, oh, there's inflation fears and things of that nature. We've seen it pull back, and I mentioned this at the start of the week, and it's calmer waters. But the situation is we've got the US 10-year Treasury bond yield, and that's slightly elevated now. So this is the 6-month chart here on the Treasury bond yield. And as you can see, it's been maintaining, below 1.3 or so percent for a little while, creeping up. And then it did actually get a lift higher. Normally that's an indicator of markets, having a sense that interest rates are coming up, and it's typically indicative of, like when we saw, if we go back to, let's go to the year to date, back in February was a lot higher as it creeped up. So it was more late February into March when we did see the pullback, and then we continue to see that selling, and it got to 1.7. So we are seeing it creep high though, but again, risk on remains in regards to what the equities are doing. So finally, I just want to share this, the news to pay attention to as well, with the economic calendar, thanks to Forex Trading Asia. So I'll just bring that up now. So we did see a little bit of news. Still, the manufacturing PMIs are elevated as well. There wasn't really anything that said slow down at all. We did have initial jobless claims. They came in slightly higher than expected, which is worse than expected, given its jobless claims data, but weekly figures, so that's not really that strong of a price mover. Now, later tonight, this is GMT +8 time zone. We've got Fed Chair Jerome Powell speaking. We've got a couple of FOMC members speaking as well. Again, though, we got most of the bang for our buck on that Thursday morning with the economic projections. So we'll just have to wait and see here. I'd like to see how the daily candle closes for the US dollar. But like Kim Hong said, you'd probably want to venture outside of US dollar pairs, and the pound is actually showing some strength. We saw that as well with the calls made in the Traders Club too. So, if this remains stable, it's just a bit tricky to say, plus the Evergrande situation on the US dollar pairs. I would say just venturing outside of that would be a little bit more appropriate. Again, though, being short-term focused and, definitely managing your risk, because there's a lot of volatility that is around, just with the uncertainty that is about in the markets. And we can see that there with the Treasury yield and also with the volatility index. All right, so that's the US index, guys. We do have quite a lot going on with the CAD as well, and we saw that last night. And we've got Jindal Tai here, multi-million-dollar trader with LCMS Traders, just going through how the CAD is looking in regards to any trading possibilities as well. So over to you now, Jin.
All right, thanks for that, Scott. So a lot of information being shared here today. Kim Hong with the details on the Bank of England minutes and statements and decisions with all that. So as he's replying to Imran now, just quickly showing you that as well, Imran here. with the minutes, the 7-2 voting numbers here is actually stated at this point. So it's voted by majority of 7-2. So it's not really a dot plot. It's not a kind of chart that's being seen. It's just a number of votes that is being received for a certain decision. So it's being stated here in the summary, monetary policy summary.